Hello everyone, welcome back to another problem tutorial from our chapter 4 tutorial series of our financial management course, BUS 223. In this video we're going to be looking at question number 3. So let's read the question together. It says, here are simplified financial statements for Watervan Corporation. And then as you can see we have the income statement of the company and we have their balance sheet as well. Okay, and then it says the company's cost of capital is 8.5%. So just as I told you in the lecture, the cost of capital, I explained the cost of capital to you, but I also told you that you're more likely than not, you're not going to be required to calculate it. You're going to be given the cost of capital in the question. So, and this is the case right here. So we have the cost of capital, which we're going to be using in our calculation. Okay. The first requirement says, A, calculate Watervan's economic value added. So let's do that. Now for the economic value added, we also need to remember our formula. So EVA, or economic value added, equals the after-tax interest, okay, plus net income minus cost of capital multiplied by the total capitalization. Okay. So the after-tax interest is going to be 1 minus the tax rate, okay, multiplied by the interest expense. Okay, then we're going to add net income, and then we're going to deduct the last term here we have, which is cost of capital, multiplied by, just writing in abbreviations here just to make sure we have enough space. And then let's go on and find our numbers. Okay, so first of all, we're going to go up right here to the income statement and find our interest expense figure right here. So the interest expense is 12, and it says here these numbers are in millions, so this is 12 million, right? And we are not given the tax rate, but we can figure it out. How can we figure it out? From the income statement, we can come here to the income before tax, which is the taxable income, and as it shows here it's 97 million, and then the taxes the company paid are 34 million. Okay, so we can simply take these and find the tax rate. Tax rate is going to equal the taxes, divided by the taxable income. Taxable income, or the income before tax, it's the same thing. So I'm going to go to my calculator, 34. I don't have to say millions because for a ratio or a fraction, the zeros don't really matter. So I'll just write 34 divided by 97, and that will give me 0.35051 something. So it's 0.35 rounded. Okay, so that means that the tax rate for the company is 35%. All right, so I'll go back here and say that equals 1 minus 0.35 multiplied by the interest expense, which was 12. Let me highlight it for you, and we'll highlight the net income as well while we're at it. So 1 minus 0.35 multiplied by the interest expense, which is 12, plus 63, was it? 63, yes. Okay. Minus the cost of capital, 8.5%, which is 0.085, multiplied by the total capitalization. Now, the total capitalization is the addition or the sum of the long-term debt and the shareholders' equity. Okay, so for us here, the long-term debt at the start of the year is 121 millions, and the shareholder equity 256 million. Okay, so the total capitalization, I'll write its formula right here for you. Total capitalization equals long-term debt plus shareholders' equity. Okay, so we'll go down here, 121 and 256. I'll open a new bracket, 121 plus 256. Okay, now 1 minus 0.35, that would be 0.65 multiplied by 12 plus 63 minus 0.085 multiplied by 121 plus 256, that's 377. Now we'll simplify our calculations further. 0.65 multiplied by 12, that's 7.8 plus 63 minus 0.085 multiplied by 377, that's 32.045. Okay. Now I'll calculate everything together. 7.8 plus 63 minus 32.045. Okay, which gives me 38.76 if we round it up, because I have 755 on my calculator. Okay, and that is in millions. Okay, which equals 38,760,000. Okay. All right. So that's requirement A completed. That's the economic value added for the company. For requirement B, what is the company's return on capital? And it says, between brackets, use start of year rather than average capital. So the question is specifically asking us to use the start of year figures. Okay. Now I'll quickly remind you of the formula for the return on capital. Equals the after tax interest plus net income. Okay, divided by total capitalization. All right. Now you notice something. You might notice that all of the inputs that are we going to be using here are also available right here, right? So the after-tax interests which is right here, this portion of our calculation. Okay, and the net income we already have used right here, and the total capitalization is this component. Okay, so we'll basically shift all of this to the top of the bracket right here, and we will shift all of this to the bottom of our calculation of the return on capital. Okay, so I could use the numbers that I have already calculated and substitute directly, but just to make sure that we are on the same page, I'm going to write down my numbers again. So 0.35 multiplied by 12 plus 63 divided by 121 plus 256. Okay. If we run the numbers again, we're going to get 7.8 plus 63, which is this part right here. Okay. So that is 70.8 divided by 377, which is this one. All right. Now we'll find the ratio, 70.8 divided by 377. That gives me 0.18779, so I can round that up to 78. Okay, and I would highly advise you to never leave the profitability ratios in this format. Okay, remember the three profitability ratios we covered: return on capital, return on assets, and return on equity. I would highly advise you to always give me your final answer in a percentage format. So for this one, we'll just multiply by 100, and that will give us 18.78%. Okay, so that's the company's return on capital. Okay, so that's the answer for part B. Now let's go back and see the other requirements. Part C says, what is the return on equity? Okay, and it says use the start of year rather than the average equity. Okay, so here we'll write part C. Now for the return on equity, quickly remind you of the formula. The return on equity uses the net income of the company divided by the shareholders' equity. Okay. Now, the net income we already know, it's 63. We used it multiple times in our calculations already. Okay, so 63 million. We'll go back and check which one of these is our shareholders equity, just to quickly remember. Shareholders equity, the start of the year, right here, 256. Okay, so 256. Crunch the numbers on your calculator and you should get your results. So 63 divided by 256, that's 0.2461. Okay, that's rounded, of course. And then transform it into a percentage, you get 24.61%. So that's the company's return on equity. Okay, last part D, is, or it says, is the company creating value for its shareholders? And the answer here is yes. What's our evidence? Our evidence is right here, because when we calculated the economic value added for the company, we got a positive number, a quite large number, 38,760,000 thousand. So yeah, we can derive from that the company is actually creating economic value for or creating value for its investors. Okay. In addition to having a positive return on capital of 18.78% and a positive return on equity of 24.61%. So this company is actually doing quite well. So all you need to do here is just put that in words. So we could say something along the lines of, they're asking, is the company creating value for its shareholders? So the answer is yes, but you need to support your answer, of course. So we'll say yes, as we conclude, for example, from our economic value added, let's say calculation results, in addition to the positive return on capital and return on equity results. Okay. The answer here might vary. You can put it in your own words as long as you answer the main or the key question, which is the company creating value for their investors? The answer is yes. But as I said, you have to support your answer either using the return on capital and return on equity figures or the economic value added result that you found from your calculation. All right. This is how you can solve question number 3. I hope that you found this video useful. If you still have any questions or want to add something, please feel free to drop that in the comments, and I'll try my best to reply to each and every comment below. And until I see you in the next problem tutorial in this series, keep on learning. Take care.